All right, welcome to the deep dive where we, help you cut through all the noise and get straight to the good stuff,
That's right.
to the core of things.
We cut to the chase.
Absolutely. So today's deep dive is particularly for you, the learner, someone who's eager to grasp big concepts, important topics, and do it pretty quickly, efficiently, and without feeling overwhelmed. Does that sound right to you?
Absolutely. And we're not going to bore you with, all that jargon that sometimes comes with these topics.
No, none of that.
We're going to make it nice and easy to understand.
Exactly. Okay, so today's deep dive, we're going to be taking a look at Benjamin Graham's The Intelligent Investor. So we've got excerpts from the book itself, which is a classic. We've got commentary from a later edition and some other little bits and pieces from, spanning several decades, really, right?
Yeah, from the original publication all the way into, the 2000s.
So, this book is really considered by many to be sort of the Bible of value investing.
Right. The foundation.
It really is, yeah, the cornerstone. And our mission today is to kind of synthesize, distill, and really understand Graham's timeless principles so that any investor can use them, regardless of their financial background or their expertise.
We're going to make this applicable to anybody, regardless of your background.
That's right. Make it easy.
Yeah.
So first, a little bit about Benjamin Graham himself. Really an incredible Wall Street pioneer.
Oh, yeah. Absolutely.
Right. I mean, his story is remarkable. He started as a clerk, navigating, the chaos of Wall Street in the early 20th century, and then eventually went on to run his own incredibly successful investment partnership, right?
Yep. He also taught.
And oh, that's right. And he taught. He was a professor at Columbia University.
That's right.
Right. And one of his students was
Warren Buffett.
Warren Buffett.
Among many others.
That's right. That's right. So even, in his early days, Graham learned some really important lessons, really, about the dangers of speculation.
Yeah, trial by fire, you might say.
Yeah, and the story, the Savile Tire story from 1919 is a great example of that. So there was this massive initial gain on Savile Tire, I think. He made many times his money, I think, really quickly. But then, of course, complete collapse.
Yeah, because it turned out to be a scam.
It turned out to be a fraud, yeah.
Yeah.
A brutal but an effective lesson, I guess.
It set him on the right path.
It did. So, Graham really became known for his really meticulous research, and the tale of Northern Pipeline Co. in 1925 is a great example of that.
Oh yeah, this is fascinating.
Yeah, so tell me about this one.
Yeah, so he was looking through some documents, some regulatory documents.
Like really digging deep.
Digging really deep, yeah. And he found out that this company, they were holding all these valuable bonds.
Hidden treasure.
Hidden treasure, yeah.
Okay.
And the value of these bonds far exceeded what, the stock market was valuing the company.
Way undervalued.
Totally undervalued, yeah.
Okay.
So he bought in. He actually advocated for the shareholders, pushed the company to do right by the shareholders, and ended up making a huge profit.
Wow.
So this deep analytical rigor, that became his trademark, his calling card.
Yeah, I love it. And, you can see those early experiences, those early lessons really shaped his investing philosophy, which has, really endured.
Right through to today.
It really has.
Timeless.
It really has. And, it's not just historical anecdotes or, war stories. It's actually, they're incredibly relevant today. Our commentator was talking about how he first read The Intelligent Investor back in 1987. And it was right before the market crashed that October. And he remembered reading Graham's warnings about, the fragility of the bull market. And then
it happened.
It just felt eerily accurate.
That's incredible.
And then, fast forward to the tech boom and bust of the late 90s, early 2000s.
.com bubble.
Yeah, exactly. and still, The Intelligent Investor and Graham's wisdom, it just continued to resonate. So this is powerful stuff, and it's why we're here today. So let's kind of dig in. What did Graham actually mean by an intelligent investor?
Yeah, that's the core question, right?
That's the core question, and I think it's important to emphasize that his definition has nothing to do with IQ. It's not about, how you did on the SATs.
No, not at all.
Okay, good, because I didn't do so well on those.
Me either.
So what is it about then? Like, help me understand this.
Yeah, so for Graham, intelligence when it comes to investing, it's really a trait of character. It's about being patient, it's about being disciplined and having a real thirst for knowledge.
Okay.
But also, it's about being able to control your emotions.
Oh, that's a hard one.
Yeah, that's a big one, right?
Yeah, yeah.
And also thinking independently. Don't just follow the herd, don't just follow the crowd.
Don't be a sheep.
Exactly,
Yeah.
because that can lead to a lot of problems. And as he famously said, it is a trait more of the character than of the brain.
That's great. I love that. And I think that's so encouraging for so many people, because it levels the playing field, right?
You don't need to be, Wall Street hotshot or anything like that.
Okay, perfect. So another big concept that Graham really emphasized was the distinction between investment and speculation.
Yes, very important.
Right. This was fundamental to his whole framework, right? So help me understand this.
Okay, so for Graham, he defined investment as an operation that after thorough analysis, after you've done your homework, offers safety of principle. That means your initial investment is safe.
You're not going to lose it.
You're not going to lose it, right?
Right.
And there's a reasonable expectation of a return.
Okay, you're going to make some money.
You're going to make some money, exactly.
All right.
Speculation, on the other hand, that hinges more on anticipating market fluctuations.
Okay, so trying to time the market.
Exactly.
Oh, okay.
Buy low, sell high, but without that same kind of in-depth analysis.
Got it.
So you're not really focusing on the fundamentals of the business.
Yeah, you're just kind of gambling almost, right?
Yeah, it's a lot more risky.
Risky. Okay. So can you give me an example, from the real world to kind of illustrate this?
Yeah, sure. So the book actually gives a really good example of an inexperienced individual who's engaging in short selling.
Oh, okay.
Which is basically betting that a stock's price will go down, even though they don't even own the shares.
Okay, so you're borrowing the shares hoping the price goes down so you can buy them back and make a profit?
Exactly. But often, this is done based on emotion.
Oh, fear and greed.
Fear and greed, yeah.
Yeah.
Or a hunch.
Yeah.
There's no real understanding of the company, the business, or the fundamentals.
Got it. So, to kind of sum it up, it sounds like investment is about, careful research.
Right.
Understanding what you're buying.
Absolutely.
And focusing on long-term value.
Long term, yeah.
Whereas speculation, it's more about trying to predict those short-term price swings.
Yep.
And, maybe make a quick buck.
But it's a lot riskier.
It's a lot riskier, yeah. And Graham, he was very critical of how, the financial industry often kind of hypes up speculation, right?
Yeah, absolutely. They glamorize it.
They do.
And they try to make it seem like it's easy. It's a get rich quick scheme.
Yeah.
But it's not.
And he believed that the speculative arena was really more in favor of the intermediaries.
Right.
So the brokers, the trading platforms,
Right.
The people who are taking their cut.
Exactly.
Right. It's not really in favor of the individual investor.
No, not at all.
Okay, so interesting. All right, so let's move on to another incredibly important concept that Graham talked about, and this is the margin of safety.
Yes, this is crucial.
The margin of safety. So what is it?
Okay, so the margin of safety is basically the difference between the price you pay for an investment and its intrinsic value.
Okay, so what it's actually worth.
Yeah, what it's really worth.
Okay.
It's like a buffer, like a cushion.
Okay.
So the larger the margin of safety, the more protection you have.
I like protection.
Yeah, right. We all do.
So, if I believe that a used car is worth, let's say, $10,000,
Okay.
but I'm able to buy it for $7,000, then that $3,000 difference, that's my margin of safety.
Perfect analogy, yeah.
Okay, good. So Graham argued that rather than, going for, those really high returns, those potential high returns that are really uncertain, those risky investment.
Yeah, the home run swings.
Yeah, exactly. That investors should really prioritize what he called the assured fruits of defensive investment. So those are the solid, dependable returns from assets that are undervalued,
Yeah.
right? And that significant margin of safety.
That's right.
Okay, and he actually looked back at the period from 1914 to 1972, which was a period of incredible volatility.
Oh, yeah.
Wars, depressions, you name it.
All of it.
And he observed that by adhering to sound investment principles that really emphasize that margin of safety,
Right.
you could generally achieve positive long-term results.
You could come out ahead.
You could come out ahead. Okay. So market fluctuations, market volatility, Graham talked a lot about this.
He did. And I think this is one of the most important things for investors to understand.
Well, especially now, right?
Oh, yeah.
The market is so volatile.
Yeah, absolutely.
So what did he say?
So he highlighted that the market downturn of 1969 and 1970.
Okay, so a couple years before he was writing this.
Yeah.
Okay.
That really should have been a wake-up call
Okay.
because it dispelled this myth that stock prices, even of these leading companies, that they would just always go up.
Yeah, the myth of the ever-rising market. Right?
Exactly.
It's a really dangerous myth.
It is.
Yeah.
And he reminds us that, it's perfectly normal for investors and speculators to experience both declines and growth in their portfolios.
It's part of the game, right?
Yeah, it's part of the game.
It's part of the game. You got to be prepared for it.
You got to have a long-term perspective.
You got to have a long-term perspective. Yeah.
And ride it out.
Absolutely. And he also pointed out really the severe impact that market crashes tend to have on those smaller, more speculative companies.
Yeah, the riskier ones.
Yeah.
And he drew a parallel to the market break of 61, 62.
Yeah.
And he consistently warns against getting caught up in the hype.
Yeah.
The enthusiasm that often sweeps through Wall Street.
Right. Everybody gets so excited.
Oh, yeah. And that can be really dangerous.
Yeah.
Because it almost always leads to a downturn.
Right.
What goes up must come down.
Yeah, what goes up must come down. So, in fact, he has a section in the book that's called Bull Market Baloney.
Yeah, it's a good one.
It really is. It's a classic. And in that, he foreshadowed the bear market of 73, 74.
He saw it coming.
He did. He really did. And, the commentary from the later editions, it really underscores this point, with vivid examples from the dot-com bubble.
Oh, yeah.
I mean, it's kind of hard to believe now, looking back at, just how inflated some of those valuations were.
And the frenzy, the speculative frenzy.
The frenzy.
It was insane.
It was insane. So give me some examples.
Oh, well, we had analysts setting these wildly optimistic price targets.
Like out of this world.
Out of this world, yeah. I mean, for companies that had little to no earnings.
It didn't even matter.
It didn't matter as long as they were .com,
Yeah.
We had day traders mistakenly buying the wrong companies.
What?
Yeah, because the ticker symbols were so similar. So,
Oh my goodness.
they were buying, companies that had nothing to do with the internet.
Just because they had similar
tickers.
Similar ticker symbols.
Yeah.
Wow, that's amazing.
And these fund managers.
Yeah.
I mean, they were just dismissing any concerns about overvaluation.
They just didn't care.
No, they didn't care. And their catchphrase was absolute growth.
Oh, I remember that.
Yeah. Absolute growth, like profitability didn't matter.
Right.
Like as long as the company was growing, it didn't matter.
The fundamentals didn't matter.
Yeah, and sustainable business models, forget about it.
Yeah, that was out the window.
Yeah, and it really just shows you how emotions and hype can distort your judgment.
They can take over, right?
They can take over completely.
They really can. So important to be aware of that. So now Graham talked about two main approaches for investors, the defensive investor and the enterprising investor.
Right.
And so tell me what's the difference between these two?
Okay. So the defensive investor,
Yeah.
they really prioritize simplicity.
Keep it simple.
Keep it simple. Yeah.
Yeah.
They don't want to have to put a lot of effort into their investments.
Okay.
They're not really trying to beat the market.
They're just trying to
You just want decent returns.
Minimize losses.
Minimize losses, right?
Yeah.
With as little work as possible.
Yeah.
The enterprising investor, on the other hand,
They're ready to put in the work.
they're ready to put in the work.
Oh,
they
yeah.
want to research companies.
They're going to roll up their sleeves.
They're going to roll up their sleeves.
Yeah.
They're going to do the digging.
They're digging for those hidden gems.
Exactly. And they're willing to take on a little more risk to try to get those higher returns.
Okay, so higher risk, higher reward, potentially.
Potentially. Exactly.
Okay, so for the defensive investor, in the early 70s,
Yeah.
Graham recommended roughly a 50-50 split
Right.
between bonds and stocks, right?
Yeah. High-grade bonds
Okay.
and high-quality stocks.
Oh, okay. And he also recommended, the strategy called dollar cost averaging, right? Which is basically investing a fixed amount of money at regular intervals.
consistently,
Consistently.
no matter what the market's
No
doing.
matter what, up, down, sideways. Just
Yeah.
keep investing. And that's a really good way for defensive investors to kind of ride out that volatility, right?
Especially if they don't want to spend a lot of time,
Without having to.
trying to time the market.
Yeah, exactly.
You just invest regularly.
Okay, perfect. And for the enterprising investor,
Yeah.
Graham talked about these special situations, right?
Yes, the more in-depth opportunities.
Okay.
So this could be things like mergers, acquisitions,
Okay.
or liquidations of companies.
Okay. So kind of like more complex events.
Yeah, exactly.
Okay.
And historically, those offered pretty good returns.
Okay.
But he did note that the profitability had gone down over time.
Because more people were doing it. Right.
More people were doing it, more
Or
competition.
competition, yeah.
So a kind of law of diminishing returns.
Okay, so interesting. And, Graham really, really emphasized the difference between his philosophy of buy low, sell high.
Right.
Which makes sense, right?
Sounds pretty straightforward.
Yeah. Buy low, sell high.
But a lot of people don't actually do that.
And he contrasted that with what he called, the typical Wall Street tendency,
Yeah.
which was to buy because prices had been going up
Yeah,
and sell because prices had been going down.
exactly. The opposite.
So they were doing the opposite. So interesting. Okay, so bonds, right?
Yeah, so bonds are a big part of a balanced portfolio,
Especially for the defensive investor, right?
especially for the defensive investor, yeah.
Okay, so what kind of bonds did he recommend?
Well, back in 72, the main choice was between taxable corporate bonds
Okay.
and tax-free municipal bonds.
Okay, munis, yeah.
Munis, yep.
Okay.
And it really depended on your tax bracket.
Okay.
So the higher your tax bracket, the more sense it made to go for the munis.
Okay.
Because you didn't have to pay taxes on those.
Got it.
And then he also mentions U.S. savings bonds as a pretty good option for individuals because they're safe and the returns are guaranteed. Okay, so those are really good for the defensive investor.
Absolutely.
Okay.
He also talks about other types of bonds like U.S. government bonds,
Sure.
agency bonds, state and local bonds.
Okay.
And he really stresses that you got to look at the ratings.
Put the credit ratings.
Yeah, from agencies like Moody's or S&P.
Okay.
Just to make sure that, the bonds are high quality.
Right.
And that there's not a big risk of default.
Got it. So he specifically warns against second-grade bonds.
Yes. High-yield junk bonds.
Junk bonds, right. Stay away from those, especially if you're a defensive investor.
Absolutely. Too risky.
Okay, good to know. So growth stocks, right? These are something that that a lot of investors get really excited about. But what was Graham's perspective on growth stocks?
He was a little bit cautious about growth stocks.
Really?
Yeah, especially for the defensive investor.
Okay, why is that?
Well, because their prices are usually really high compared to their earnings.
Okay.
And there's a lot of uncertainty about their future growth.
They might not live up to the hype.
Exactly. He pointed out that even, big growth companies like IBM and Texas Instruments back in the day,
Oh, yeah.
and more recently Microsoft and Cisco, they've all experienced some pretty big price declines.
Right.
Even though their businesses are still pretty strong.
Oh, okay. Interesting.
So, it's really tough to predict how those growth stocks are going to perform in the long run.
So for somebody who's just trying to, invest defensively, not put in a lot of time,
Right.
He recommended maybe staying away from those.
Yeah, generally, yeah.
Okay, good advice. So for those defensive investors who don't want to, pick individual stocks,
Yeah.
Graham talked about the option of investing in funds.
In funds, right, yeah.
Okay.
So he suggested that buying shares in a well-established investment fund could be a good option.
Okay.
And these could be common trust funds, which are managed by banks, or you could use an investment advisor if you have a lot of money to invest. And the benefit of that is that you get, professional management.
So they're doing the work for you.
Yeah, and they're diversifying your investments.
Okay, good. And the commentators, they also talked about index funds.
Oh, yeah. Index funds are great.
Right.
Yeah, because they're very low cost.
Okay.
And they track the whole market.
Okay.
So, like, if you invest in the S&P 500 index fund,
Yeah.
you're basically buying a tiny piece of all 500 companies in that index.
Okay.
So you're very diversified.
Diversified.
Right, and it's very low cost.
That's great.
And it's a great way to avoid trying to time the market.
Yeah, and pick individual stocks,
Exactly.
which can be very difficult.
Yeah, yeah, very difficult. And
I-
and they actually pointed out that the top performing stocks over, say, a 30-year period,
Yeah.
they're not always the companies you would expect.
Right. It's not always the Apples and the Amazons.
No, not at all.
Okay.
It could be companies you've never even heard of,
Yeah, it really emphasizes the benefit of diversification.
right? Even being patient.
Being patient, yeah. Okay, so shifting gears a little bit to the enterprising investor, the one
Yeah.
who's willing to put in the work.
Yeah.
How did Graham recommend that they understand and assess a company's intrinsic value?
All right. So for the enterprising investor, they really need to dig deep into the financials.
Okay, so look at the balance sheet.
Yeah, look at the balance sheet, the
Mhm.
income statement, the cash flow statement,
All the good stuff.
all the good stuff, yeah. And really look at things like the book value.
Okay.
And be careful of companies that have too much debt.
Okay, yeah.
Yeah.
Too much debt is never good.
Not good, no.
Yeah.
And then he also introduced this interesting concept of net working capital,
Okay.
which is basically the company's current assets
Okay.
minus its current liabilities.
Okay.
So like, cash on hand, inventory, accounts receivable, that kind of stuff,
Okay.
minus, the short-term debts that they have to pay.
Yeah.
And he said, if a stock is selling for less than its net working capital,
Okay.
that could be a sign that it's a bargain.
Wow.
Like you're essentially getting the fixed assets for free.
Wow, that's amazing. So the liquid assets alone are worth more than the entire market cap of the company.
Exactly. Yeah.
That's crazy. Okay. So what else did he recommend?
Well, he also said, you got to compare the company's historical earnings, its past performance,
Okay.
to its current market price.
Okay.
So, look at the track record of the business.
Okay.
And see if it's really living up to, what the market's pricing it at.
Got it.
And then another thing he said to be wary of is companies that are too reliant on what he called other people's money.
OPM.
OPM.
Okay.
Okay. So if they're borrowing a lot of money
Okay.
or issuing a lot of new shares, that could be a sign that they're not really financially healthy.
Right.
They're just masking their weaknesses.
Got it. Okay, so moving beyond just the numbers, beyond the financials,
Right.
Graham also talked about the importance of really understanding the shareholders' role
Yeah.
and the quality of management.
Yeah. So he believed that shareholders really need to be informed
Yeah.
about how the company's being run.
Yeah, do your homework.
Get to your homework. Yeah.
Okay.
And they need to make sure that their interests are being protected.
Right.
So he said, read the proxy materials,
Which are?
which are basically documents that companies send to shareholders
Okay.
before their annual meetings.
Okay.
And these documents tell you about, what's going to be voted on and who's on the board of directors and all that kind of stuff.
Okay, important stuff.
Yeah. And you got to vote your shares.
You got to be active.
You got to be active. Yeah.
Yeah.
You got to be informed.
And he used the example of Enron and LJM.
Oh, yeah. That was a big
A
one.
huge scandal.
Yeah. It was really bad. And it showed what can happen when there are conflicts of interest.
When people aren't paying attention.
When people aren't paying attention. Yeah.
Yeah. So a good reminder to, to read those proxy statements and to vote your shares.
Absolutely.
Okay, so what about dividends?
Dividends.
And stock buybacks?
Right.
What was Graham's take on these methods of returning capital to shareholders?
So Graham generally believed that companies should pay dividends.
Okay.
He said that the burden of proof is on the company to justify not paying a dividend.
Okay, so why would they not pay a dividend?
Well, there could be some reasons, like maybe they're reinvesting the money in the business.
Okay.
But he said,